Good day and welcome to the Q4 and FY2025 earnings conference call of Axiscades Technologies Limited, hosted by MUFG Insight. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference has been recorded. I now hand the conference over to Ms. Sangeeta Tripathi. Thank you, and over to you, ma'am.
Thank you, moderator. Good evening, everyone, and welcome to the Q4 FY25 and the full year FY25 results conference call of Axiscades Technologies Limited. I am joined today by our leadership team to provide a brief overview of the business performance, financial results, along with our strategy ahead. We have with us today Dr. Sampath Ravi Narayanan, our chairman, Mr. Alfonso Martin, our managing director and CEO, D. Murali Krishnan, our chief operating officer, Mr. Shashidhar SK, our CFO, Mr. Arunabh Sharma, our president, ESAI and CEO at Solutions, along with Mr. Shardi Babu, our president of Defense. Before we begin, please note that this call may contain forward-looking statements based on company's current expectations, beliefs, and opinions. These statements involve risks and uncertainties, and the actual results may differ materially. Now I hand over the call to our CFO, Mr. Shashidhar SK. Over to you, sir.
Thank you, Sangeeta. Good evening, everyone, and I'm delighted to welcome you all to this earnings call for Q4 FY25 and the full year FY25. I hope you all had an opportunity to review our press release and the investor presentation, which are available under the investor section of our website, and the same are accessible in the BSE and NSE websites too. To begin with, despite a challenging macroeconomic scenario in certain of our non-core verticals, we are delighted to report that we have closed the financial year FY25 with a significant milestone of crossing 1,000 crores in consolidated revenue. While we are recalibrating our automotive, energy and heavy engineering verticals, our growth was led by our focus verticals of aerospace, defense and ESAI. The full year revenue for FY 2025 was at 1,031 crores, recording a growth of 7.9% over the previous year in rupee terms and 5.7% in constant dollar terms. While the reported EBITDA for the year is at 142 crores, a growth of 7% over the previous year, the adjusted EBITDA came at 156 crores, a growth of 17% over the previous year, adjusting for non-recurring and one-time expenses incurred in Q3 and Q4. Our PAT grew by 2.25 times over the previous year at 75.26 crores as against 33.41 crores in FY24, leading to a diluted EPS doubling from 7.74 rupees to 17.22. The company since Q3 of FY25, under the guidance of our chairman, has embarked on major business transformation initiatives to turbocharge the business and achieve non-linear product-led growth, both in revenue and margins, in each of our core verticals, namely aerospace, defense and ESAI. The company is also evaluating and recalibrating its non-core businesses of heavy engineering, energy and automotive, which are till date negatively impacted by macro factors and are growth and margin dilutive to the enterprise, as has been elaborated in our investor presentation. The company is deploying resources and costs for this transformation, which is expected to be stabilized by Q2 of FY26. These costs and investments are critical to ensure enterprise readiness to progressively achieve our aspirational target of achieving $1 billion revenue by 2030. Coming back to our business performance in FY25, our core domains grew by 12% from 671 crores to 749 crores, driven by aerospace, which grew by 13% to 322 crores, and defense, which grew by 16% to 303 crores, with production revenues from defense growing by 19% to 198 crores. Our non-core businesses of heavy engineering, automotive and energy together constituted 282 crores in revenue, a 3% degrowth over previous year. Automotive and heavy engineering together degrew by 7% to 238 crores, and energy vertical at 43 crores grew by 30% on a small base. The core verticals continue to record healthy EBITDA margins at 19.1% and is being diluted to 13.8% at an enterprise level due to negative margins in the non-core businesses. The reported EBITDA margin is at 13.8% for the year, which is the same as in previous year, despite the fact that the company incurred one-time and non-recurring costs of around 14 crores in Q3 and Q4, mainly senior leadership settlements, legal costs, and one-time consulting for our automotive business. Adjusting for this, the EBITDA margin for the year is at 15%. Considering only our core businesses of aerospace, defense, and ESAI, our EBITDA margins are at a healthy average of 19.1%, with aerospace coming in at 21.2%, ESAI at 23.9%, and defense at 15%. Of the defense revenues of 303 crores, if you only take defense production revenues, which was at 198 crores, the EBITDA is actually at 22%. So the prototype revenues of defense at about 105 crores was very marginal and slightly negative from the point of view of EBITDA. We intend to improve our EBITDA margins by about 300 bps each year with focus on non-linear product-driven growth in core verticals and realignment of non-core verticals. As stated, our core verticals are already yielding EBITDA margins of 19%. With effective execution of product-led strategy, by FY28, the company aims to invert its current revenue mix of 80% service revenue and 20% product revenue, which will be the key driver for non-linear margin-led growth, with the aim and objective of achieving an average of 24% EBITDA in the next 2 to 3 years. With respect to business performance in Q4 of FY25, the company's revenue was at 268 crores, growing by 4.8% year-on-year and degrowing by about 2.4% quarter-on-quarter as the execution of some of the defense programs moved to the right. The company's reported EBITDA was at 37 crores at 14% and adjusted EBITDA was at 45 crores at 16.8%. The company has been able to significantly reduce its finance cost from 56 crores to 32 crores with repayment of borrowings from QAP proceeds. The company's net debt is just at about 15 odd crores, excluding lease liabilities, with gross debt standing at 189 crores and cash, bank and liquid investment at 174 crores. The company has a healthy balance sheet with shareholders' equity standing at 656 crores as against 592 crores in the previous year. To conclude, we are highly enthusiastic and committed on our path ahead. Our focus on scalable product-led growth, underpinned by significant investment in infrastructure and leadership, positions us for sustained long-term growth. This strategy will enable us to unlock substantial value for our investors and stakeholders. I now invite our CEO, Mr. Alfonso Martinez, to provide his views.
Thank you, Sasidhar, and good afternoon, everybody. I'm really happy and pleased to participate in this, my first quarter presentation as a group CEO. And complementing Sasi's presentation and speech, I would like to highlight the transformation of the company that we are currently driving. This transformation is going into 3 axes, as mentioned in the presentation. First is people. I'm very pleased to announce that now our new management team is in place. We have all the presidents in place. We added veterans on the industry in a leadership position for the last 30 years, and this is already starting to boost our relationships with our clients. An amount of progress is being done in that aspect. This will lead, no doubt, to an unprecedented growth. We are also starting to train our existing sales force into a new way of selling, new way of engaging with the clients. Second axis of the transformation is moving from the traditional services to products and solutions. This is key for the margin expansion that we are forecasting. And third, the investments in key assets with very high return. And this is already, as we will discuss later in the presentation of our Chief Operating Officer, leading to a new area. As a golden rule for next year, I would like to say we have 3 key objectives. First is a minimum growth of EBITDA of 50%, excluding ESAI cost. That's the very first target. Second, the profit after taxes will increase proportionally. And third point, we want to increase the quality of our revenues. With that, at least 300 basic points of EBITDA percentage improvement. This will lead to all the future. But for this year, these are the three parameters that we are targeting. And as a golden rule, we will achieve. Now I would like to lead my presidents to present you the different verticals. Unfortunately, Mohan Krishnan, our new president for aerospace, is not present. He's in a very important client meeting today, and I will take this part. Starting by aerospace, I will say that our target for fiscal year 26 is at least 35% growth in revenues. That will change the path of growth of the previous years. Deepening engineering expertise, now empowered with artificial intelligence, moving from traditional service to really disruptive solutions. Some of our services are already ongoing this transformation with spectacular results. Also, we are building manufacturing and supply chain solutions. This action is particularly driven by Mohan Krishnan, that brings with a strong background in these areas of manufacturing and supply chain. Our current Airbus engagement, our number one client in aerospace, we as a strategic supplier are long-term settled with that. We are about $40 million of yearly revenues, and this is a long-term established. We are also discussing to expand this partnership from these areas into new fields. And also forging new partnerships with the OEMs and tier ones of aviation. As you can know, India has become the center of gravity of commercial aviation. And that's a very, very important point in our strategy. Said that, I let the word to Sari Babu in defense, and he will explain you the keys of this vertical. Please, Sari Babu.
Thank you, Alfonso. Good evening, everyone. This is Shardi Babu, President of Defense at Axiscades. And as you heard, we have created a very strong base for business with a stellar performance at 303 crores. And we continue our focus on defense production and also very specific focus on new product development, especially in the areas of radar, electronic warfare, missile systems, and unmanned warfare systems. And right now we are on a very strong growth path, and we expect the growth to be at a rate of about 75% moving forward, and also on a similar focus on the bottom line also. And our order books are now reaching about 1,800 crores. And we hope this emergency procurement also will actually have some success for us. And then going forward, we're looking at a very, very strong defense growth. So, also, we are having a very strong practice going on at the OEMs, and there are many programs coming up at the OEM level. Overall, we are looking at addressing the entire DRDO and also the MOD practice and also the OEM programs. And with that, I would like to hand over the session to Mr. Anurag Sharma, who is the head of our electronics, semiconductor, and artificial intelligence. Thank you.
Hi, good evening, everyone. I am Anurag Sharma. I am president of ESAI, which is basically electronic, semiconductor, and artificial intelligence wing of Axiscades. Now, I would like to tell you that why three? What is the combination of these three? So this is the combination of electronic, semiconductor, and artificial intelligence is the one which is churning out the fastest and most innovative products across the globe. And this is the space where we already belong. And we have a very robust pipeline in terms of the order book. We are close to 600 crores plus of order books with us. We are doing a growth of 60%, more than 60%. And speaking more specifically on the products, we have a lot of focus on products. Products are not new to us. We have been doing products, but now we are offering complete system level products. And for that, we have taken a new initiative. We have started a product development center in Fremont in California, where we have multiple products which are being conceptualized, developed, tested, and then manufactured across the globe. We also have started a lot of sales reinforcement in Europe, with our headquarters being in Germany, and we are trying to set up a product sales ecosystem across various channels, resellers, and so the idea is that our both products and solutions shall reach to maximum clients. We also have our company LED Solution in Germany, where we are doing a lot of wiring harness development and also specific products like micro data center and also solutions like thermal management. So all these initiatives are with a view to increase our presence in this sector across the globe and increase our revenues. So with that, I would like to give the mic to my colleague and COO, Mr. Murali Krishnan.
Thank you, Anurag. Good afternoon, ladies and gentlemen. This is Murali Krishnan, Chief Operating Officer of Axiscades. We have seen vision in our chairman's statement, which is there in our investment presentation. We have a vision to become a billion-dollar company in 2030. We call this as Power 930. As a COO, I take the responsibility to carry out this vision. This vision is also coming up with a high EBITDA of 24%, and this vision is going to be driven by flipping our product versus services revenue. From today, at a level of 20% product, we are going to move to a 80% product and solutions-based organization. So in order to enable this, I do three things. First, enable the organization to deliver the AOP with the right processes, with the right resources. Two, transform the organization for the future. And three, provide world-class facilities and resources to take up our Power 930 vision. This infrastructure is going to come up in two places. One is called as DAC, Devanahalli Atmanirbhar Complex at Bangalore, which is a 20-acre facility. This is going to come up in three phases. Phase 1 is going to handle radar and electronic warfare solutions, development, manufacturing, testing, maintenance. Phase 2 is for missile complex, missile MRO as well as missile manufacturing. While missile MRO would happen at Bangalore, we also are planning to set up another facility at Hyderabad to establish our presence in missile manufacturing. Phase 3 would come up with MRO, speed shop and supply chain facilities for aerospace and defense customers. We want to construct these facilities in 3 years' time. First phase will come up in this financial year itself. This facility of phase 1 would cost 250 crores and the first phase 1A of it would cost 120 crores, which would be mostly through internal funding. We are also looking for strategic partnerships for the infrastructure development, which is through a company called AAIPL, Axis Aerospace Infrastructure Private Limited. With this, I request our chairman to say the concluding remarks on our speeches. Over to you, sir.
I think you.
Thank you, Murali. My colleagues have covered all the aspects. I've set the goal for the company, brought in the team of capable leadership team who can deliver the goal. However, I've tasked myself with the following. One is to create a robust silo or funnel that leads to a pipeline and wins to achieve the Power 390. So I'm tasked myself with that creating that silo, contacts, everything, that leads to this goal. So which has to be done in the next 2 years so that we can deliver on the third, fourth, and fifth year the goals while the AOP keeps going on. Second is, as Murali mentioned, ensure our DAC and MAC projects are completed on time. For that, we need resources and funds. So my job is to organize that without any dilution. So the land is owned by a company, one of our group companies, as you would have known, called ESAI, Axis Aerospace Infrastructure Private Limited. We are trying to leverage or bring some strategic partnership into that and achieve this. This is one of the options. As Murali also mentioned that 1A, we are splitting the whole approach into 3 phases. 1A we are pretty much covered. So rest of the things we have to organize. So we have time to organize. Okay. The third thing is forge long-term partnerships and relationships to achieve this. Hope to get the more the work for the work as well as for the completion of DAC and MAC projects. So this will also have a sustainable growth and achieve the 930 in a sustainable way. So with this, we are ready to take the questions. So I'll hand it over to Sangeeta, who can just organize the questions. Thank you. Thank you all.
Yeah, we can start with the Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kaushik Mohan from Ashika Group. Please proceed.
Hi, sir. Thanks for the opportunity and great set of results. Can I just understand this one-time cost on the P&L that we have it on more clarity basis?
Yeah. So, Kaushik, thank you for the question. See, essentially, as what I explained in my speech, we went on a complete transformation initiative from Q3 onwards. And one of the major parts of this is kind of complete overhaul of the leadership team. And essentially, the major cost with respect to the 14 crores which I mentioned pertains to, it not only was in India, it was also across globally where, we had to kind of, do a kind of a voluntary separation for, our leadership, including our, the previous, CEO and various other leadership positions across the globe. So that, and also we had to incur certain, one-time legal costs in the course of a few exits, so to say. And then we also took a specific consulting, from, Zinov with respect to our automotive business, which, I would say, especially for ADD solutions in Germany. All of this amounted to 14 crores, which in a way are non-recurring in nature, which will not repeat next year.
Got it. And sir, the second thing, currently in this quarter, we have achieved almost around 16.8% EBITDA margin. And we are talking about the target of power to 930, where we are talking about a 24% EBITDA margin. So what are the key levers which will play out in this specific margin increase? And how is that plan towards achieving that? And also, can you relate this with that 80-20 rule that we are talking about product as well as the solutions?
Yeah. So before I hand it over to Alfonso and Murali to kind of detail on this, I would like to say that, while our kind of a blended EBITDA is at 13.8%, you would observe that the 3 main core businesses where the future growth is going to come is already at a 19% EBITDA. If you look at aerospace, that's at 22%. And if you look at, ESAI, that's also at about 23% plus. And if you look at only the defense production, that's already at 22%. So the approach is to take it from here and drive it towards the product-led approach. And I will ask Alfonso to kind of say, and also to Murali, if they want to delineate on how this entire drivers are going to work out.
Yes, exactly as Shashi said, it is mainly driven by our focus. Our focus in aerospace, defense, and ESI will bring this margin improvement. if you see, as I said, we are running there around 20% in combination this year, but specifically also defense is only at 15%, and we will expect for next year, for fiscal year 26, an expansion of that EBITDA margin very clearly. So it's a combination of improving the balance between core and non-core, and of course also increasing the quality of our revenues. And we are very, very much secure on that. I don't know if you want to complement Murali or more or less this is.
Yeah, thanks, Alfonso. So I think you are right. So once we focus on products and increase the share of our products, the EBITDA margins are going to improve. Also the uniqueness of the products. So if we are the only supplier and if our products are innovative and unique, the margins are going to be higher. That is the way we want to go forward. 80-20 is the way where we will increase our EBITDA. So Chairman may please add if you want to have any comments on this, please.
No, I'm fine. As we said, that this is a goal we have set. As Sashi explained, we are already at 19.2% with the core verticals. And defense is also, if you take only the defense product solutions, without taking out the one-time development cost, it is at more than 20%. So we should be fine if we keep the focus, and that's what we are planning to do.
Okay. Great. Thanks for this, sir. I'll come back in the queue.
Thank you. Before I take the next question, ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. The next question is from the line of Jatin Jadhav from Sahasra Capital. Please proceed.
Hello, am I audible?
Yes.
First of all, thank you so much for this opportunity and congratulations on a great set of numbers. I have 2 questions. One is, sir, can you again briefly explain me the phase 1, phase 2, and phase 3 in brief? And so my second question was regarding phase 2. If I heard it correctly, you were trying to build a facility for missiles, MRO, and manufacturing. So I wanted to understand what kind of missiles are we targeting to manufacture for the defense for the defense clients, and what kind of MRO facilities are we trying to build over here for existing missile systems or for future missile systems? So those are.
I will take this questions. Basically, phase 1 is meant for all the electronics, strategic electronics, that will cover and normal electronics also. That will cover so that also includes radar, electronics warfare, strategic electronics, and ESAI electronics. So that should cover pretty much our strategic electronics group and ESAI group. So that will have a manufacturing facility and high-level test facility, including anechoic chamber, etc., which there are very rare availability in India. And it will also have a large hangars for radar maintenance, radar assembly, etc. So that means radars are widely used. For example, I'm just giving an example. Some of the AWACS use large radars that can come in and then test it. This will have wide hangars to test all these things. This is phase 1A. So this will cover radar, electronics warfare, and all the other strategic electronics and normal electronics, manufacturing, testing, assembly, and so on. And so the phase 2 we talked about is missile. Missile has 2 parts. Missile, we maintain the launchers. When we say missile maintenance, there are 2 parts: launchers and missile transportable test benches, where the missile can be assembled. The 4 components of missile can be assembled at the war zone or wherever it is. So these are some of the ecosystems we are building, and also we are building the ground systems. That part may happen in Bangalore. But the missile part, when we say missile manufacture, this is more like an assembly. Some parts we are planning to manufacture, including airframe, including rocket motors, and even the munitions for missile at some point of time, warheads, and then the nose cone, the front part, and of course missile electronics, that's onboard computing, etc. So this will happen the whole integration will happen in Hyderabad. We are targeting to manufacture more. We are focusing on smaller missiles which is more into air to surface and so on. I don't want to reveal too much, but this will be the focus on the missile side. And third is MRO, speed shop, and manufacturing will be focused on dual use. That will be mostly for both aerospace and defense. There are many aircraft. For example, Boeing aircraft are used for Boeing 737 is used in defense as well as here. Airbus is used both in the. So there are cases where there are a lot of dual use aircraft and helicopters. So we'll be doing maintenance of the parts, both avionics and engine parts and some parts of airframe, and manufacturing and supply chain for this. This will be phase 3. So except the missile-related activities, missile assembly, everything will be in Bangalore, which will be Devanelli Atmanirbhar complex. Missile Atmanirbhar complex, that will be in Hyderabad. That will come up in a 6-acre facility, which are yet to buy. We are in the negotiation with the Telangana government, or talking to the Telangana government. Not here. We are already, we have acquired the land and we are starting up the work. We are in the plan approval stage at this stage. Okay. Thank you.
Thank you so much, sir. I'll get back into the queue. Thank you.
Thank you. The next question is from the line of Karthi from Suyash Advisors. Please proceed.
Good afternoon. Thanks for the opportunity. Sir, I just wanted to understand the visibility for the revenue growth guidance that you've given, 35% for Aero, 60% for defense and 75% for ESAI. I hope I got those numbers correct. Just wanted to understand how much of this is contingent upon maybe order wins or whatever, or customer approvals to go ahead, and how much of this is, shall we say, routine. Some clarity on that would help.
So, I will, Alfonso, would you want to talk about aerospace first, followed by Sharadi Babu on defense, and then, of course, Anurag who will explain about ESAI.
Yes. On aerospace, we have a base of revenues that is secure with our current customers. Luckily, both customers are in a good shape, and the revenues that we make this year is nearly secure for next year, plus some expansions. So that's securing a part of the growth in aerospace. Also, the rest is coming from the pipeline of opportunities that we have now. It's a pipeline we started to build basically when I joined, and then we are now weighting the pipeline, and with the secure revenues plus a weighted pipeline, we are nearly 90% of the secure on the revenue increase. There is always, we are starting the year, and there is always some deals to be won along the year. And I hope that we are putting a lot of hope in the Paris Air Show, in which we will participate. We may have announcement of some important deals that will come in the aerospace side. So basically, it is an estimation that we are pretty much secure, and we are very confident on getting this 35% growth of revenues in aerospace. They also maybe, Bob, you can complement on the defense side.
One quick question: how much would be the two customers' contribution?
The two current customers.
Yes.
Yes, that's nearly a similar revenue to this figure. So if it is a 35% increase, you can make the maths, very easily. In the current customers, we are expanding about 10%, basically.
Oh, sure.
So this is coming from the pipeline with new customers. When I say new customers in Airbus, that is very big. Airbus is a full ecosystem. We have one current customer in Airbus, but Airbus is a very big group, and we are expanding into new areas as well.
Sure. I heard you. Thanks.
Thanks, Alfonso. Covering the defense part, the defense growth is coming from the much of our defense production, where we are, as you know, we are part of the LCA, Sukhoi, and also the AWACS program, and also multiple our both radar and EW are going on multiple platforms. So production is from different all these programs, and also we have the MOD programs. We are implementing a large land systems defense program in the coming year. And also, we are the OEMs, the thing has opened up with various activities happening, and the new procurement from defense has triggered a lot of OEM programs. So much of activity is also happening on the OEM, global OEM programs. So it is spread across all these three areas.
And also, I just want to clarify. The question was little wrong, captured wrong, that defense is 75% and ESAI is 60%.
Okay,
So
sure,
growth.
sure.
Are you just reiterate that? That's all. Okay, thank you.
Sure. Yeah.
And also the counter drone systems where we are in the forefront, and we have already supplied 100 systems to the defense. So we are expecting repeat orders, and also the new programs. There are a lot of the counter drone is the most wanted system across the defense now, and then we are leading this entire program supply of these counter drone systems to the Indian defense.
Right. So, if I may clarify, what would be production revenue in FY26? You did 190 roughly in FY25. So,
production revenue is
this year FY25 was around 196 crores.
Yeah.
They're talking about probably doubling it in FY26.
so okay. Thank you.
Thank you. The next question is from the line of Nishid Shah from Ambika FinCap Consultants Private Limited. Please proceed.
Yeah, hi, this is Dhruv. Congratulations on a good set of numbers. I have just one clarification on the defense side. The deal we announced.
Sorry to interrupt, Mr. Nishid. Could you please come closer to your device?
Can you hear me? Hello.
Yes, we can.
Yes, sir.
Yeah.
I just had one clarification on the defense side. The deal we announced on the test bench, is any revenues included in the growth which we are saying, 75%?
Yes.
Which deal you are talking about? We are not able to. Hello?
The MBDA deal which we announced in January for the test bench, have we included any revenues from that, sir?
Babu, can you answer this?
Excellence which we inaugurated.
Yes, we have revenues in that program in FY26. Yes, sir.
Okay, that's it. Sir. Thank you so much.
Sure.
Thank you. The next question is from the line of Deepak Podar from Sapphire Capital. Please proceed.
Sir, I'm audible, sir?
Yes, you are.
Yeah. Thank you very much, sir, for this opportunity. So just wanted to check, our 9,000 crores kind of a target in next 5 to 6 years, basically. So that kind of equates to about 40-45% kind of a CAGR over next 5-6 years. So just wanted to understand, do you expect this growth to be evenly phased over the years, or do you expect it to be front-ended, back-ended? What sort of thought process you have on that?
Yeah, I'll take this question. This year one, let us call this as one T0, beginning this right now. This will be a normal year. The AOP will be met as CEO mentioned. We are looking at a 50% EBITDA growth and proportional PAT growth this year. And because we are infrastructure, I think 60% should be ready. So next, some traction other than the AOP figure, something towards the organization will come next year. But the third, fourth, and fifth year, I think we will ramp up faster, because by that time most of the DAC will be completed, MAC will be completed. All the third phase will be almost on. So all the lines of revenue streams will be ready. So I think it's still a vision, but I would say that it's very much possible to achieve this.
Okay. And this year we're targeting 35% growth at the company level?
This year, we are not looking at revenue per se. The revenue will be 35%, I guess. But I am saying profit after adjusting because we have a huge cost on ESOPs. After adjusting, our EBITDA still can be around 50% growth from the current level. And that will be proportional. And EBITDA margin will be at least at 17%, so average. So you can do the math. What should be the revenue and what should be the
and what is the FY26 ESOP cost we are expecting?
Around 50 to 60 crores.
Around 50 to 60 crores.
Yeah.
Okay. And what is the tax rate? This tax rate we have seen some.
Yeah.
So definitely, we have now moved to the new tax regime. Of course, as you know, we have global operations, and each of the, I would say, our global operations have a different, tax rate. But in India, we have moved to the new tax regime at 25.82%.
So 26% is effective tax as we can expect at the country level.
That's right.
And what was the one-time provisioning cost in fourth quarter?
Sorry to interrupt, Mr. Deepak.
It's just the last question, yeah.
Join to the queue.
One-time provisioning, I didn't get you.
One-time cost in fourth quarter. Just one-time cost in fourth quarter. What was out of this 14 crores? What was the cost in fourth quarter?
The fourth quarter was around 9 crores.
9 crores. Okay.
7.5 crores. Let me correct myself.
7.5. Okay.
Yeah.
Okay. That's it from all the very best. Thank you.
Thank you. The next question is from the line of Astha from PK Day Advisors. Please proceed.
Hello, am I audible?
Yes, you are.
Yeah. Thank you for giving me the opportunity to ask the question. So first, I want to ask you: we saw the slowest growth in this year in FY25 compared to last 3-4 years. What was the reason? I mean, what happened? We saw 13% growth in aerospace, which was again slower than compared to previous years. And sir, in the similar line, I want to ask you, what was the revenue growth in automotive segment?
No, the automotive segment, talking about the revenue growth as such, you're right. The core businesses is where the actual growth happened. And most of the, I would say, management bandwidth as well as, I would say our efforts were getting into ensuring that we reset the non-core verticals, and we were exposed to the macro factors, especially in automotive. Just to give an example, the acquisition which we did of ADD Solutions in Germany, where, I would say Volkswagen was a main customer, which, there was a huge degrowth there. So we did not achieve the objectives. That was the, issue there. And also with respect to the acquisition which we did in energy of Efcogen, you yet to hit critical mass. As a result of which, the non-core, verticals kind of, I would say, impacted the overall growth in terms of the business. And as to the automotive vertical, the total automotive revenue was 91 crores? 90 crores, as against 104 crores which we recorded in FY24.
But even aerospace grew only by 13%, whereas if I see from FY22 to 24, it has grown pretty well.
Yeah, so because we, I would say we had some new programs which we started implementing.
No. That is post-COVID. That is went up. Okay, that is clear because there is a complete lot of orders were held back. That's the result of.
So just to elaborate on what Dr. SRN just now stated, if you look at the period from FY23, if you look at FY22, which was the the period of COVID, the revenues dropped by 50%. So when the COVID the growth came back, it came back with a vengeance. So that kind of stabilized in FY24 and onwards.
So going forward, should I expect 13 to 15% growth as my aerospace growth?
So I think I'll
take the question. Madam, this year we are expecting, as our CEO on behalf of Mohan said, 35%. If I can give the figures, approximately we did about around $38 million in aerospace. We are targeting about $51 million this year, approximately. Okay, so we can expect, and we are looking at a similar or better growth next year because we'll be adding products and solutions to this. Okay.
Got it, sir. So my next question would be, is it possible to say?
Could I request you to return to the question queue, as there are several participants waiting for their turn?
Sure. Thank you.
Thank you. Before I take the next question, ladies and gentlemen, to incorporate all questions, I request you to limit your questions to one question per participant. The next question is from the line of Nirvana Laha from Badrinath Holdings. Please proceed.
Hi, thanks for the opportunity. My question is regarding the ESAI segment. So if I look at the revenues this year, they were flat. We are guiding for, I think, 60% growth in EBITDA next year. So can you please elaborate on what programs or what clients will help us drive this? Some details on where we can, understand what tangible programs or clients will help move this will be very helpful.
Yes, of course. This is Anurag Sharma here. So you see that we are basically also doing a revision in our strategy where we are moving towards product-driven growth. And in that context, we have introduced some new products also in this year. And that is why we are very much confident of this growth which I spoke about. So we already were doing a certain type of products for our OEM clients in the semiconductor segment, and we were doing high-end electronic design and PCBAs. But now we are doing our own system-level product which directly go into the market. So this is something which is a renewed strategy and very effective one, and that gives us the confidence to move forward. Thank you.
Sir, just a follow-up on that. So 60% EBITDA growth, do you already, and I think we reported 24% EBITDA margins this year. So the EBITDA growth, how much of that will be driven by top-line growth and how much will be driven by further EBITDA expansion, if you already have some plans around that?
So you are talking about ESAI or you are talking about the company?
No, ESAI. ESAI is 125 crore revenue, I believe, with 30 crore EBITDA. So 60% EBITDA growth that we are targeting, what will be the split between the revenue growth in ESAI and further EBITDA margin expansion?
This is mostly coming from the revenue growth. So we are going to substantially increase the revenue.
See, we have added a lot of new logos. Earlier, there used to be, 2-3 logos which were kind of focused with respect to the entire ESAI revenues. Now we are adding quite a lot of new logos, especially in the US region, which is going to kind of, I would say, take this forward. Yeah.
Yes, if I may complement, the revenues flow in ESI in the previous year has been delivery-led. It's basically the sales done many years ago, and we have continued. And what we have done now is really boosting the sales and the relationships with the clients, together with a new product strategy. So by the continuity of the current revenue streams is there, but on top of that, we are adding new OEMs, new clients, etc., and new product range that has not been done in the company for the last years. There's a new era now.
We have interesting.
So anyway,
please go ahead.
Traditionally had only two silicon manufacturers with us, which have brought in 80% of the revenues. Now we are having about 3 or 4 more silicon manufacturers to work with. Number 2, we have taken a strong China plus one strategy and the tariff plus one strategy. So that means that we are going wherever there was a replacement activities are required. That has boosted our order book. The entire 60% we can say is almost 90% of this covered with already an order book right now. It's a good question of execution. There is a robust pipeline. And customer base, we have some marquee customers. So basically, these 3 things put us a confidence. And the EBITDA growth is proportional. There won't be a BIPS growth. There is no basic point growth. The EBITDA will remain almost the same percentage, but it will be a result of revenue growth. Revenue growth will be there. Also, there is a small element of ESAI in with ESAI. Everything is being
Thanks a lot.
Thank you. Before I take the next question, I would like to remind participants, please limit your questions to 1 per participant. The next question is from the line of Dhaval Jain from Sequent Investments. Please proceed.
Hello, sir. So I just wanted to understand the contribution from our core business going forward, because right now what I see is out of the total contribution that we have in aerospace is 31%, defense is around 29%, and ESAI is around 12%. So moving forward, how is this mix going to change? Is it going to be evenly split, or is defense going to be more contributing to the core domain?
Let me answer this question. Ravi Narayan here. So this is around. We are expecting at 2028. We are expecting. Leave the non-core aside. We are looking at 40% in defense, about 30% in ESAI, and 30% in aerospace. That's a mix we are expecting at this point of time with the visibility among the core activities.
Okay. Also, one more aspect of it I might have missed out on. So I just wanted to know about the capex that we are doing for the 3 phases that we are going to put in. So I see that we are going to put around 250 crores in the phase 1. That's phase 1A contributing 120 crores. So can I have the understanding of how you're going to fund the phase 2 and phase 3, and what will be the total capex overall?
In my brief for the thing, phase 1A. In phase 1, we have divided it as phase 1A and phase 1. Phase 1A pretty much is that is 120 crore. That we are already allocated 45 crores from our internal crores. I will be allocating more money. We make internally. Phase 1B onwards require external funding, which our main focus is going to be on the strategic partnerships for the development of the whole thing. That's what it is. Okay.
We don't currently have the entire capex the entire amount of what we're going to plan in, or is it going to come later stage?
You see, as Dr. SRN explained, what we have on the radar and which is under development, where the plan is at an approval stage, is the phase 1A, where the capex, including the building as well as the equipment, is going to be anywhere between 100 to 120 crores, of which, most of it, our objective is that most of it should be through internal accruals. As I've already mentioned, the company is sitting on cash reserves. At the same time, the generation of EBITDA in FY26 is also going to support that. So that is how the phase 1A is going to be funded. And onwards, basically, as what Dr. SRN was explaining, we are working on partnerships where there can be a contribution from the the partner who will negotiate with the OEM, which will take this entire capex forward.
Okay, sir. Okay, thank you.
Thank you. The next question is from the line of Ruchita Gadge from iWealth Management. Please proceed.
Hello, sir. Very good evening. So, sir, my question was essentially on the capex part only. So, on the phase 1 that we're talking about, so the phase A, I understood. Could you please reiterate, on the phase B, what would that be, and by when do you expect the A and the B to come, and how much revenue can each at the peak capacity contribute?
It's already work started, somewhat the planning, approval, etc. We hope to complete the phase 1A by December this year and moving by January 15th at the latest. So phase 1 is on track. Phase 1B, as we conceived, will have certain level of tool room machine shops. We call it as feed volume manufacturing shop, and some kind of activities for supply chain and inspection equipment. And so this will come in that more towards aerospace to take care of some of the aerospace activities. More onto the one-time development, one-time manufacturing of aerospace parts. Just to explain to you, around 90% of the OEM spent, that is, Airbus, Boeing and their ecosystem, spend their whole entire money with the.
Hello. Sir, we are losing you. Hello? Yeah, I think you can take the question. Yeah.
Yes. So as SRN sir explained, so there is phase 1 which is about 1 year away. So we are able to complete that, and then we will move and start the operations next year. And phase 2 and 3, which are for missiles as well as for the MRO and speed shop, that will come in the subsequent. Yes.
And about the phase one, if you could tell that what is the kind of peak revenue that we can expect in the phase one?
So this will be a part of our upcoming AOP, and phase 1A is more related to radar.
No, we are expecting just to add to what Murali said, we are expecting a healthy kind of an asset turnover here, at least by 2 to 2.5 times is what we can expect.
Okay. And how fast can we ramp this up?
Revenues will start as soon as the facilities are ready. And our plan is beginning of next year, that will be ready. Sometimes, today's supply chain of equipment and so on is difficult to predict, But we are very confident that beginning of next year, and we have some client discussions also. So revenues will start flowing early, as soon as the facilities are ready. The pipeline is very big, and we are more or less securing the contracts in parallel to the investments in the phase 1A. So that will boost specifically fiscal year 27. It's very difficult. These facilities are going to be ready at the end of this year, so the impact will be in the subsequent years. The return on capital expenses is very high in everything we are planning. This is for phase 1, and basically. Next phases are depending on the customer negotiations and the client partnerships that we are closing in this year. As long as we will be announcing the partnerships, the investments will be also putting into know of the community.
Okay, understood. And this ESOP cost, what was that for FY25?
Ruchita?
The ESOP cost for FY25 was kind of marginal. It was less than 5 crores, let me say.
Understood. And then just to a follow up on this.
Yeah.
So
Ms. Ruchita, we are so sorry, but there are a lot of participants waiting for their turn. Could you
not an issue.
to the question queue? Yeah.
Thank you. Yeah.
The next question is from the line of Aman Rich from Astute Investment Management. Please proceed.
Yeah, good afternoon, sir. My question is on the defense side. So could you give some more clarity that till last quarter or maybe 1-2 quarters back, we were talking about 30% kind of production growth. But what has changed in last 1-2 quarters that we are now talking about 100% growth in our production revenue? And then if you can talk about some of the interesting programs which is coming up, which is helping in this. Is this the Netra program? And if you can give any update, and also on counter drone and APG drone pod update, if you can give on these 3 programs. These are the questions I have.
Sure. Mainly the defense program, the production is coming from, as I mentioned in one of the previous answers, there is a ramp up in production. We are actually significantly contributing towards the production of the LCA, the Su-30 upgrade, and also in the AVAX. And also we are having the direction finding the system is going on multiple platforms. So much of the production is happening in this direction, and also there is an expedited deliveries. In fact, we have the orders. It is the execution which is actually more where we are focusing and then enhancing it. And also we are with the culmination of the new orders from the OEMs like the Marine Rafale and others are also expediting our OEM, expanding our OEM footprint. Okay, so we already working with many global OEMs, and there the expansion is happening on an accelerated mode. And in the MOD, so we are number one. We have a couple of we are implementing a land system project, and also we are expecting this emergency procurement to lead to certain quick supply of systems where we are expecting this emergency procurement, and also maybe there will be one more iteration also will actually contribute to our enhanced revenues.
Then clarification on the emergency procurement part. What kind of contribution do you think can come from that? And sorry, this Su-30 and AWACS. So these programs were supposed to come in FY27. So
is it getting preponed, or when you are talking about so many programs, all of them are coming in FY26 itself?
There are some subsystems already the production is going on and then deliveries are going on. Some of them are actually coming up in this year and some quantities are next year. And also the emergency procurement, there are 10 lines of items the Indian MOD has embarked upon acquiring in a quick succession, and we already fielded our equipment in 4 categories, and then at least we have very high confidence that we should be able to win one of them, and and also the same will also repeat in a very quick succession down the line.
Sorry, again, what is the order we are expecting from EP emergency procurement in the next 1-2 years?
No, I will not be able to disclose the values, but we are hoping for a sure wins.
Okay, thank you.
Thank you.
Thank you. The next question is from the line of Pankaj Parab from Molecule Ventures. Please proceed.
Hello, am I audible?
Yes.
Hello?
Yes, you are. Yes, you are.
Yes, thank you. Thank you for the opportunity. So, my first question would be on the recent traction in the anti-drone system. So, what kind of new opportunities that we are seeing, and are we developing any new system except from the existing system in anti-drone?
Yes, we are actually expanding our anti-drone systems offerings. We are in the counter-drone systems. We are already in the man-portable counter-drone systems, and now we are offering the handheld systems also. And also we have worked on the vehicle-mounted, and then we have offered the vehicle-mounted systems also. And going forward, we are actually creating our own internal portfolio of long-range and programmable jammers, and also future add-on integrate our own radars. And so we'll be offering a full suite of counter-drone systems, including all the sensors and the kill options, both the soft sensors and soft kill, hard sensors and hard kill options. All of them will be part of our offerings. So it's a pretty interesting portfolio of products, and also a very good pipeline coming up. And already we are in the forefront of counter-drone systems in the Indian context, and also we are expanding globally also.
And sir, can you please elaborate some of the order in the counter-drone system in FY26 that may be converted into revenue?
The values I'll not be able to disclose. So, but I'm sure counter-drone systems will be part of our revenues.
Okay, so we can safely assume that the amount of the revenue will be substantially higher than FY25, I guess so.
Yes. Yes.
Okay. And my yes, please continue.
Yes, to complement on Mr. Babu said, it is not only the products that we are developing, it also the recent success that we have last year in counter-drone systems here in India has drive the attention of some international companies that are looking us as a main partner to develop. So this will accelerate, because as you can imagine, developing our own products takes some time. But what is going on is that now we are now about to announce very soon a very good partnership on these systems with the leaders companies, and as you know, I come from Europe, and there we are experiencing a lot on drones, and what we are doing is partnerships with companies that are combat proven systems, and that's why we are putting a lot of bets on these counter drone and even drone systems. So this is we are super confident. I'm sorry, this is defense. We cannot disclose the opportunities we are dealing with and the conversations we are having with the international OEMs and also the Ministry of Defense here in India. But we are super confident on a big boost on these revenues.
Okay. And sir, my next question is on ESAI segment. So we have a good jump in the quarterly revenue for this quarter in the ESAI segment. And sir, you also mentioned the 600 crore order book. And So, can you just elaborate what is the portion of the chip to product the division that we are trying to develop, and how we are progressing there? Any new product addition in the pipeline or anything on that, sir?
So for ESAI, there are multiple products in pipeline, starting from millimeter wave radar, drone controller, as well as no other radar systems such as through wall radar and ground penetration radar.
And sir, does this contain in our order book of 600 crores?
Hello. Sorry to interrupt, Mr. Pankaj. Due to
Yes,
time constraints, we'll have to take this as the last question.
Thank you.
Thank you. Ladies and gentlemen, in the interest of time, this will be the last question and would now hand the conference over to the management for closing comments.
Thank you, everyone. Thanks to all our esteemed leaders and participants for your time and interest in our company. We appreciate this engaging session and the insightful questions. Should you have any further questions or need any additional clarification, please feel free to connect with us. Thank you.
Thank you. Thank you, everyone.
Thank you.
On behalf of Axiscades Technologies Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.